Good day everyone, my name is Baijuquin Bandila and today I will be discussing the financial statement, their structure and usefulness to managerial finance. By the end of this presentation, you should be able to explain the usefulness of financial statements, identify the 5 limitations of financial statements, describe the 3 basic financial statements, understand the financial analysis techniques, and explain managerial finance concepts. Financial statements are among the most important sources of information used by financial managers. They are prepared by the accounting department and provide by financial data needed, evaluate a company's performance, and make informed business decisions. Although financial statements have certain limitations, they are still very valuable because they summarize the financial condition and overall performance of a business. Before we discuss the 3 major of financial statement, let's first understand some of their limitation. Moving on to our next topic, let's discuss the limitation of financial statement. While financial statements are incredibly useful tool for analyzing companies' performance, they don't always give us the complete they don't always give us the complete unrestricted pictures. In fact, there are 5 key limitations that every manager and decision maker needs to keep in mind. Let's break this down one by one, starting with historical costs. Moving on to our first key point, recording asset at the historical cost or appraised value. In accounting, assets are recorded at their historical cost or appraised value, not their current selling price. However, managers care more about the actual cash they can get if they sell the asset today. For example, this building was bought in 2015 for 2 million, which remained its book value on the balance sheet but remain its book value on the balance sheet. But today its market value is 5 million. Second is the variation in application of accounting principles. Even though companies follow GAAP, they are not allowed to use different methods to estimate and measure their financial performance. This flexibility means two identical companies could report completely different results. As you can see in the table, there are 3 common areas where methods vary. First, we have inventory, depreciation, and bad debts. Inventory are companies can choose between FIFO or weighted average, which affects the cost of goods sold. And for the depreciation, to spread out the cost of an asset, they can use straight line, units of output, or sum of the year's digits. For bad debts, to estimate uncollectible accounts, they can use aging methods, a percentage of sales, or a percentage of accounts receivable. Ultimately, this shows us that to truly understand financial statement, we can just look at the final numbers. We have to understand the method used to calculate them. Third is financial statement only cover a specific period of time. They provide a snapshot of business at particular date. They cannot fully show the company's past history or predict its future performance. Another limitation is that financial statements do not consider the effect of inflation, since the purchasing power of money changes over time. Some reported values may no longer represent their true economic value today. Lastly, financial statements only record measurable financial transactions. They cannot include non-financial factors that can also affect company success, such as customer satisfaction, employee performance, management quality, or brand reputation. Despite this limitation, financial statements remain essential because they provide reliable information for planning, controlling business operation, and making sound financial decisions. Now let's move on the three major financial statements. There are three primary financial statements that financial managers commonly use to evaluate a company's performance and financial condition. First is the income statement. The income statement reports the company's revenues and expense over specific accounting period. It begins with net sales, then subtracts the cost of goods sold to determine the gross profit. Next is operating expense are deducted to calculate the operating income. After considering other income, interest expense, and taxes, the final result is net income, which is also known as bottom line. Manager use the income statement to determine whether the company is earning a profit and how effectively it manage its expense. The second is financial statement the second financial statement is the balance sheet. The balance sheet represents the company's financial position at a specific point of time. And it consists three major components, which asset, liabilities, and equity. Asset, which are the resources owned by the company. Liabilities, which are the company's obligation or debts. Equity, which is represent the ownership investment or ownership in the business. These three components follow the basic accounting equation, which is the asset equal liability plus equity. The balance sheet helps managers evaluate the company's financial strength, liquidity, and its ability to meet both short-term and long-term obligations. The third financial statement is the statement of cash flow. The statement of cash flow shows where the company is cash from and how it is used during the specific accounting period. Cash movements are classified into three main activities: operating activities, investing activities, and financing activities. First is operating activities, which involve companies' normal day-to-day business operation. And second is the investing activities, which include buying or selling long-term assets such as equipment or property. And lastly, third is financing activities, which involve borrowing money, issuing share, repaying loans, or paying dividends. Unlike the income statement, this report focuses only on the actual movement of cash. Manager use the statement of cash flow to determine whether the company generate enough cash to operate efficiently, invest in future growth, and pay its financial obligation. To summarize this part, the income statement, balance sheet, and statement of cash flow each provide different but equally important information about company's financial performance. The income statement measures the profitability, and the balance sheet shows the company's financial position, and statement of cash flow explain how cash moves in and out of the business. Together, these three financial statements serve as the foundations for sound financial planning, analysis, and decision making. Now that we have better understanding of financial statement themselves, let's move on how these statements are analyzed. I will now hand over the discussion to our next presenter, which is Sophia Gulam. So thank you everyone.
Good day, everyone. Before we begin, let me introduce myself. I am Sofia Farhana Al Gulam, and today I'll be discussing financial statement analysis and its different types and techniques. So, let's get started. Financial statement analysis refers to the process of evaluating a company's financial performance and financial condition by analyzing its financial statements. It helps managers, investors, creditors, and other stakeholders understand how well a business is performing and make informed financial decisions. In simple terms, financial statement analysis helps us answer questions like: is the company making a profit? Is it financially stable? Is its performance improving or getting worse over time? Now, let's discuss the different types and techniques used in financial statement analysis. First is horizontal analysis. Horizontal analysis compares financial information from two different accounting periods. The earlier period serves as the base year, and the current period is compared against it. This allows us to determine whether important financial items such as revenue, expenses, assets, or liabilities have increased or decreased over time. For example, if a company's sales were about 1 million pesos last year and 1.3 million this year, we can see that sales increased by 300,000 or 30%. This type of analysis is useful because it helps managers measure business growth, identify trends, and detect significant changes in financial performance. The second technique is vertical analysis. Unlike horizontal analysis, vertical analysis focuses on only one accounting period. Instead of comparing different years, every item in the financial statement is expressed as a percentage of a base amount. For the income statement, each item is compared with net sales. For the balance sheet, each item is compared with total assets. This makes it easier to understand how much each account contributes to the overall financial statement. Vertical analysis is useful especially when comparing companies of different sizes because percentages are easier to compare than actual amounts. The third technique is trend or time series analysis. Trend analysis is similar to horizontal analysis, but instead of comparing only two periods, it compares financial data across several years. Its purpose is to identify long term patterns or trends in the company's financial performance. For example, if sales continue to increase every year for 5 consecutive years, that indicates a positive trend. Managers use trend analysis to evaluate whether the company's condition is improving over time and to make forecasts for future performance. The fourth technique is financial ratio analysis. Financial ratio analysis measures the relationship between different accounts in the financial statements. Rather than looking at numbers separately, ratios help evaluate important areas such as profitability, liquidity, efficiency, and financial stability. For example, ratios can help answer questions like: can the company pay its short term debt? Is the company earning enough profit? Is it using its resources efficiently? Financial ratio analysis provides a more complete picture of a company's financial health because it combines information from different financial statements. When looking at a company's financial statements, the sheer volume of numbers can be overwhelming. That's where financial ratios come in. They act like a health checkup for a business, summarizing complex accounting data into simple, meaningful scores. Let's break down the four essential categories of key ratios every analyst, investor, and business owner should know. First up, we have liquidity ratios. This measures a company's ability to pay off its short term obligations. Basically, can they pay their bills on time over the next year? Under this, we have current ratio and quick ratio. For the current ratio, this compares everything a company owns that can be turned into cash quickly, its current assets, against everything it owes soon, its current liabilities. For the formula, we have current assets divided by current liabilities. For example, if a company has 500,000 pesos in assets and 250,000 pesos in liabilities, its current ratio is 2.0x. This means it has twice as much cash and short-term asset as it needs to cover its immediate debts. For the next one, we have quick ratio. This is a stricter test. It strips away inventory from your assets because inventory can sometimes take a long time to sell. For the formula, we have current assets minus inventory, then divided by current liabilities. For example, if we remove 150,000 pesos worth of inventory from our assets, The remaining quick assets divided by liabilities gives us a ratio of 1.4x. It shows the company can still comfortably pay its bills even if sales completely freeze tomorrow. The next one, we have solvency ratios. While liquidity looks at the next few months, solvency ratios look at long-term survival. They tell us how a company uses debt to fund its growth and if the debt is sustainable. Under this, we have debt to equity ratio and interest coverage ratio. Debt to equity ratio, this measures the balance between what the company borrowed versus what the owners invested. For the formula, it is total liabilities divided by total equity. Example, with 400,000 pesos in liabilities and 600,000 pesos in equity, the DE ratio is 0.67x. This means for every dollar of equity, the company has 67 cents of debt, a relatively safe balance. Then we have interest coverage ratio. This measures how easily a company can pay the interest on its borrowed money using its operating profit or EBIT, earnings before interest and taxes. The formula is earnings before interest and taxes divided by interest expense. For example, if a company makes 200,000 pesos in earnings before interest and taxes and owes 40,000 pesos in interest, its coverage ratio is 5.0x. It earns 5 times more than its interest obligations, meaning the risk of defaulting is very low. Next, we look at activity ratios, also known as efficiency ratios. This show how well management is using the company's assets to generate revenue. Under this are total asset turnover and inventory turnover. Total asset turnover, this measures how efficiently a company uses its entire asset base to generate sales. For the formula, we use net sales divided by total assets. For example, generating 1.2 million pesos in sales from 800,000 pesos in assets gives an assets turnover of 1.5x. Every dollar of assets translates into 1.50 pesos of sales. The next one, we have inventory turnover. This tells us how many times a company sells and replaces its stock of goods over a period. For the formula, we have cost of goods sold divided by average inventory. Example, if cost of goods sold is 600,000 pesos and average inventory is 150,000 pesos, the turnover is 4.00x. This means the company cleared and restocked its shelves four times during the year. High numbers generally mean great sales efficiency. Finally, we have the last one, which is the profitability ratios. This is all about the bottom line. How much money is the business actually pocketing? Under this are net profit margin and return on equity. Net profit margin, this tells us exactly how much profit is earned for every single dollar of sales generated. For the formula used, we have net income divided by net sales. Example, if a company brings in 1.2 million pesos in sales but walks away with 120,000 pesos in net income, its net profit margin is 10.0%. 10 cents of every sales dollar is pure profit. The next one, we have return on equity. This is the ultimate metric for shareholders. It measures the profit earned on the money investors put into the business. For the formula, we have net income divided by total equity. Now, let's discuss the uses of financial statement analysis. Financial statement analysis is useful to several groups of people. First are the providers of capital, such as investors, creditors, banks, and suppliers. They use financial information to decide whether they should invest in or lend money to a company. Second are government regulators, including agencies like the SEC, BIR, COA, and BSP. They use financial statements to ensure that companies comply with laws, regulations, and reporting standards. Lastly is the company's management. Managers use financial analysis for planning, budgeting, decision making, evaluating performance, and improving business operations. Next are the limitations of ratio analysis. Although ratio analysis is a very useful tool, it also has several limitations. First, companies operate in different industries, so comparing ratios between unrelated businesses may not produce meaningful results. Second, companies may use different accounting methods which can affect their reported financial figures. Third, seasonal businesses may slow misleading ratios depending on the time of the year when the financial statements are prepared. Another limitation is inflation, which may reduce the accuracy of financial data over time. Some companies may also practice what is called window dressing, where they make their financial statements appear stronger than they actually are. Finally, there is no single ratio that is always considered good or bad. The interpretation depends on the company's industry, size, and overall situation. Now, let's discuss the standards used in financial analysis. Managers do not simply calculate financial figures, they also compare them using different standards. These standards include past year's performance, where current results are compared with previous years; industry average, which compare the company's performance with the average performance of similar businesses. Third one, competitors' performance, where results are compared with competing companies. Then we have the budgeted performance, which compares actual performance with the company's planned budget. And the last one, we have the nominal or expected standards, where results are compared with predetermined targets or goals. These comparisons help managers determine whether the company's performance is improving, staying the same, or declining. To conclude, financial statements provide important information about a company's financial position and performance. However, these statements become much more valuable when they are properly analyzed. By using techniques such as horizontal analysis, vertical analysis, trend analysis, and financial ratio analysis, managers and other users can evaluate business performance, identify strengths and weaknesses, monitor progress, and make better financial decisions. Overall, understanding both financial statement and the different methods of financial statement analysis is essential in managerial finance because they support effective planning, control, and decision making. That concludes my presentation. Thank you everyone for listening. Have a great day.